Here are the calculations for Seri Mercedes Berhad that refer to attachment 1. Firstly, for current ratio show that Seri Mercedes Berhad has enough current asset to pay the current liability compared to industry average. For inventory turnover ratio show they are not doing good in turnover the inventory compared to industry average. On to the average collection period, which is ACP, Seri Mercedes Berhad, we experience difficult in collecting payment for customer, which is they are take 101 days compared to industry average, which is 18 days. So for non-current asset, turnover show the company are efficient utilizing the non-current asset to generate the revenue compared to average industry. For total asset turnover, show that Seri Mercedes Berhad may not be using the asset efficiently to make money. Might have the asset they have aren't generating enough revenue.
For debt ratio, Sri Mercedes Berhad has a higher financial risk compared to the industry average. For time interest earned, Sri Mercedes Berhad generates enough income to cover its interest expenses and has enough operating income compared to industry average. For net profit margin, Sri Mercedes Berhad is not efficient in its operation and has lower financial performance compared to its industry average. Next, for return on assets, Sri Mercedes Berhad is not profitable and efficient in utilizing its asset to generate profit compared to industry average. Lastly, for return on equity, Sri Mercedes Berhad management is not efficient at generating income and growth from its equity compared to its industry average.
Now let's see areas of the firm liquidity, leverage, profitability, and assets management ratio. For liquidity firms, Seri Mercedes Berhad current ratio indicates that they have a more than enough current asset to cover their current liabilities. This means they in a strong position to meet their short-term obligation. In comparison to the industry average, Seri Mercedes Berhad current ratio is higher, which is a positive sign. It shows that they have a better liquidity compared to other companies in the industry. Overall, the current ratio suggests that they have a healthy ability to handle the short-term financial commitment. On the areas of the firm leverage ratio, Seri Mercedes Berhad in particular has a higher debt ratio compared to the industry average, indicating that they have taken on a greater amount of debt relative to the total asset. So this higher leverage ratio can introduce the financial risk, so as a significant portion of the asset is financed through debt. It is crucial for Seri Mercedes Berhad to carefully manage the debt obligation to maintain financial stability and mitigate the potential risk. Next, on areas of firm profitability ratio, Seri Mercedes Berhad should not be as efficient in its operation compared to the industry average. However, despite this, the company is still able to generate profit. Financial ratios such as net profit margin, return on equity, and return on asset provide further insight into the company profitability. Despite potential operation inefficiency, Seri Mercedes Berhad demonstrates its ability to remain profitable through various means. Area on the firm asset management ratio, which is Seri Mercedes Berhad asset management ratio, it becomes evident that company is not efficient utilizing its asset compared to the industry average. This is reflected in the lower asset turnover ratio, indicating that the company is not generating sufficient sales from its asset. Additionally, a lower ROE compared to the industry average will indicate that Seri Mercedes Berhad is not generating a satisfactory level of profit.
Moving on to the next question, I will now explain about the weaknesses and recommendation. Upon observation, Sri Mercedes Berhad exhibit multiple weaknesses of its own. Sri Mercedes Berhad first shortcoming is having trouble at managing its inventory turnover ratio is high relative to the industry average of 4.5 times, where their turnover ratio is 2.66 times. This could lead to a number of issues. A low inventory turnover ratio may indicate weak sales, weak market demand, or an inventory glut. To improve the efficiency of Sri Mercedes Berhad inventory turnover ratio, consider implementing the strategies. Firstly, set competitive prices for the product to increase demand and generate higher sales. Secondly, eliminate all stock and update the inventory to remove outdated or slow-moving items, making spaces for new and popular products. By implementing these strategies, Sri Mercedes Berhad can optimize their inventory turnover ratio, reduce carrying costs, and boost sales. At the moment, Sri Mercedes Berhad's second shortcoming is their average collection period, which is 101 days instead of the industry average of 80 days for debt collection. This implies that Sri Mercedes Berhad is having trouble in collecting debts. In other words, early debt collection can lower the chance of default or non-payment. They may develop a more effective system for generating and monitoring invoices in order to increase the average collection period's efficiency. They also can provide rewards for one-time payment or penalties for late payment. With the use of this technique, Sri Mercedes Berhad can quickly notify clients about payment problems. Due to a larger financial risk in debt ratio, Sri Mary Sdn Bhd is experiencing difficulties. Among the consequences is higher default risk. A high debt ratio indicates a business has more liabilities than assets, which raises the possibility of loan default. Second, their losses could get compounded because if a business with a high debt to equity ratio has losses, these losses may accumulate and make it more challenging for the business to repay its debt. To improve this, one can obtain better inventory management and profitability by increasing both of them. Additionally, by arranging debt repayment condition to pay off higher interest rate first and using debt payback to make additional principal payments. Subsequently, Sri Mary Sdn Bhd is facing challenges in handling its total asset turnover, which stand at 1.34 times the industry average of 4.5 times. A low asset turnover ratio, which is one of the consequences, suggests that Sri Mary Sdn Bhd is not making the most of its resources and might be going through internal difficulties. There are several ways to increase the total turnover asset efficiency. One strategy to boost income is to look for methods to sell more goods or services. Reducing inventory or making the best use of already existing goods are the two further strategies to enhance the inventory management. Sri Mary Sdn Bhd can lower the amount of risk and equity required to operate while increasing income for each dollar of asset by increasing the asset turnover ratio. Sri Mary Sdn Bhd is facing issues in managing Sri Mary Sdn Bhd's net profit margin, which is 9.4% lower than the industry average 10%. A lower net profit margin could be due to factors like high operating expenses, weak pricing power, or inefficient cost management. To improve their net profit margin, Sri Mary Sdn Bhd should focus on controlling costs, develop effective pricing strategies, and improving the operational efficiency. It's important for the company to analyze the reason behind the lower net profit margin and take appropriate measures to enhance profitability and financial performance. In summary, Sri Mary Sdn Bhd with a lower net profit margin compared to the industry average should carefully evaluate its cost structure and overall business efficiency. Regretfully, Sri Mary Sdn Bhd is having another problem managing its return on asset, which is 12.6% as opposed to the 15% industry average. High debt level and ineffective asset management are two factors that can contribute to a reduced return on asset, which can have a detrimental effect on the company's capacity to earn a profit. A number of methods can be put into action, including reducing costs through increasing productivity, renegotiating with suppliers, or locating new suppliers. These strategies can also help minimize expenses like payroll, suppliers, and shipping prices. Secondly, boosting revenue can be used to strengthen sales tactics, investigate new market needs, and improve customer services. A business can minimize return on asset, enhance financial performance, and meet its financial objective by putting these techniques into operation. Last but not least, Sri Mary Sdn Bhd struggled to manage its return on equity, which is 17.78% compared to the industry average of 19.23%. Less efficient use of equity is one factor contributing to the poor return on equity. A lower return on equity may indicate that Sri Mary Sdn Bhd fails to utilize the most of its equity to drive growth and revenue. In addition, a weak competitive edge may imply that Sri Mary Sdn Bhd is not successful and expanding over the long run as its business counterparts. They can take into consideration of methods that are by reducing taxes are a result of effective tax management and increasing asset turnover to produce more sales. From the same number of assets can increase return on equity.
To answer question number 2, for the first, which is our revenue. In the 2020-2021, the Perdua revenue decreased due to the COVID-19 pandemic, impact the costing of the disruption in the production supply chain challenge, and reduces a consumer demand. This leads a cost-saving measure including adjustment in the material labor and overhead of expenses as well as scaling down and the productions to the match of market condition. In 2021 to 2022, the company revenue is expected to increase the possibility due to refine the pricing strategy, such as adjustment of pricing, better reflect the vehicle value, and introducing the flexible financing option and offering attractive deals to attract the budget the conscience of consumer. This strategic pricing adjustment likely influence the consumer behavior, contributing to the increase of sales of volume and enhancing of the Perdua's competitive position in the automotive industry. Next, for the net income, the rises of Perdua's sales volume could be attributed to the successful marketing campaign and the introduction of a new car model, which is likely attracted the customers and capitalize on innovation. This is a combination of with the strong marketing tactics and enticing of product offering demonstrated the company flexibility in responding to the market changes and the meeting of customer demand. Furthermore, the product of chance and chance of profit margin may result from the strategic cost of cutting initiative of improve operational of efficiency and the potential of the modify the pricing tactics. All contributed to increase the profitability. This factor indicate the improved cost of control and the revenue stream optimization, strength, and the company financial performance. And the last one, which is expenses. Perdua total expenses fluctuates over the years, declining from 2020 to 2021, then the rising in 2022. The decrease in 2021 may have influenced by the short-term cost and cutting measure to the counter of economic fluctuation or industry shifts. This measure could involve the slowing the productions to the match of a reduce of demand and a renegotiation of supplier contract a better terms. In 2022, increased expenses may have attributed to high competition in the automotive industry, leading the broad boost of investment of marketing and sales of a strategic move involve a target advertising, promotion and enhance of sales initiative to expand the brand presence of attract a new customer and secure a large of market share. Despite the rising of costs, a primary objective is sustain the growth and ensuring a good of return on investment in the competitive of automotive market.
I will continue to the third question, which is a difference between trend analysis and interfirm comparison. Before we start, I would like to tell a little bit about what is trend analysis and interfirm comparison. Trend analysis is analyzing the past data, identify and forecast performance and trend in market. For the interfirm comparison, is technique used to evaluate the performance efficiency, cost and profit of firm. Now, let's take a look to the table about a difference between trend analysis and interfirm comparison. To make it clear, I already do a table that provides a difference for each scope. For the first scope, which is focus, trend analysis involves assessing the performance of a single company over time, tracking its financial metrics and indicators. On the other hand, interfirm comparison look at the financial performance of various companies within the same industry and sector. Next, for the data focus, trend analysis primarily leverage historical data of a single company to identify patterns and trends over time. In contrast, interfirm comparison involves the comparison of current financial data among multiple companies simultaneously, providing a real-time snapshot for assessing relative performance within a specific time frame. Additionally, trend analysis delves into a company's past performance, while interfirm comparison focuses contemporaneous financial data across different companies. For a time perspective, trend analysis emphasizes a longitudinal view, examining performance changes over an extended period of identify pattern and tendencies. In contrast, interfirm comparison provides a snapshot comparison focusing on the specific point in the time to gauge the relative strengths and weakness among different companies within the same industry. Trend analysis look at the long-term trajectory, while interfirm comparison offer a more immediate assessment. Lastly, trend analysis is often employed for strategic planning, forecasting, and understanding a company's long-term financial health. On the other hand, interfirm comparison prove useful for benchmarking, competitive analysis, and making decisions related to industry positioning and market competitiveness. In essence, trend analysis guides long-term strategy, while interfirm comparison aids in making informed decisions within the competitive landscape. For the second question in question 3, which is explain some inherent problems and constraints of ratio analysis using example. First, inconsistent accounting policy. The issue different company may follow various accounting method, making it challenging to compare ratio directly. For example, one company might use FIFO, first in first out for inventory valuation, while another use LIFO, last in first out. Second, inflationary effect. For the issue, inflation can distort financial ratio, affecting the real value of asset and earning. In example, in an inflationary environment, historical cost accounting may undervalue asset, impacting ratio like return on asset. Last is lack of industry norm. Ratios may not have universal benchmark, making it difficult to determine whether a specific ratio is good or bad without industry context. For example, a debt equity ratio of consider high for one industry but normal for another.